Doctors, if you want to build significant cash flow and financial freedom outside of medicine while paying less in taxes, then you don't want to miss the in-person Physician Freedom Summit this October, where 5-minute conversations could lead you to your next mentor, partner, or increase your net worth by millions. I'm Param. I'm a radiologist, a mom, a real estate investor, and founder of GW Capital and Generational Wealth MD, a growing community of over 20,000 physicians whom I have helped acquire over $300 million worth of real estate. But just like you, for over a decade, I was trudging along the traditional W-2 path, overworked, struggling to balance work and life. Looking back, many of these speakers shaped my journey, and at the Physician Freedom Summit, you will be in the room having face-to-face conversations with these short-term rental gurus who've replaced their clinical earnings through their real estate while slashing their tax bill by hundreds of thousands of dollars, creative financing and alternative investment experts who became financially free in their 30s and 40s and together manage over $1 billion in assets. And you will get insider access to the wealth building strategies that they're pivoting to in this market cycle, while others sit on the sidelines missing out on this once in a lifetime opportunity to build generational wealth. I'm super excited about seeing all of you in person in beautiful California. I know this is going to change your life. I will see you there. Don't forget to sign up at generationalwealthmd.com/summit. Okay, so everyone, super excited about today's topic. I know there's been a lot of turbulence in the market with President Trump's tariff plans being announced, and there is a lot of uncertainty amid investors. And I guess the biggest questions are always, okay, is this still a good time to invest in real estate? Can investing in real estate still help me lower my taxes, knowing that bonus depreciation is phasing out? What's happening with the tax code? What changes can we expect for 2025? I'm super excited to have Thomas Castelli, my friend. He's a CPA, a tax strategist, and a real estate investor. He's worked with hundreds of real estate investors and helped them reduce their tax bills using tax strategies such as real estate professional status, the short-term rental tax strategy. And I'm super excited to deep dive into what we can expect as real estate investors in terms of tax optimization strategies for 2025, what potential tax changes are in store, especially what's happening with 100% bonus depreciation. So thank you, Tom, for doing this.
Welcome to Generational Wealth MD's podcast on financial freedom through investing in real estate. My name is Param. I'm a mom, radiologist, real estate investor, and mentor to others looking to start or scale their real estate portfolios. The goal of this podcast is to provide you with inspiration, strategies, and insight so that you can stop trading your time for money and live life on your terms. If you love the episode, don't forget to subscribe and leave a review.
Thanks for having me. It's always a pleasure to be here.
Absolutely. I remember I was with Brandon in his first tax strategy foundation course, which was, I think, 4 years ago. It was when you guys started it. And when I think about real estate savvy CPAs, our community works a lot with your firm, and we always appreciate the support. For those of you listening, we talk always about real estate having multiple ways that you're generating returns, right? There's cash flow, there's market appreciation, there's debt pay down, and then again, it's a hedge against inflation. But one of the biggest things we lean into as real estate investors is the tax efficiencies, right? And that's something we can control. What is happening with the market is something we really don't have control over. So we're thinking in the long term over there. But tax strategies can be super powerful. We have a lot of students within our coaching program who invest in short-term rentals and long-term rentals, and some of them shelter over $800,000 of clinical income from taxes in 1 year. And we have passive investors who have 6 figures in tax-free cash flow. That's just by investing passively, and they have this additional stream of income. So I'm super excited to deep dive into the tax strategies. Before we get started, though, for those of you listening, we have the Physician Freedom Summit coming up in October, and we are going to be deep diving into tax strategies there. We'll have hands-on workshops on how you can actually implement a lot of what I'm going to be talking about with Tom. So if you haven't signed up, prices go up next month. So go to generationalwealthmd.com/summit in lowercase and make sure you sign up. But that being said, Tom, I know that, we could go many different directions here, but let's start off with, maybe just backing up and generalizing for real estate investors, right? Even for passive investors, how can real estate investing really be a huge tax shelter? And let's talk about tax efficiencies in general.
Yeah, absolutely. So let me just kind of start with a quick crash course of the U.S. tax system, right? So most earned income, we're talking about income from your job or a business that you might be running, is going to be taxed at your ordinary income tax rates, which are up to 37%. There could also be, in addition to that, state taxes, FICA taxes, which is Medicare and Social Security. And then if you're self-employed, you get to pay both half sides of that up to 15%. So earned income is not the most efficient source of income, although it's often necessary for many reasons, right? Whereas with real estate, rental real estate, you can shelter well, let me back up here. So rental real estate, the rental income is also taxed up to 37%. So that's something to note. However, with real estate, you have depreciation, which you can use to shelter that rental income from tax. So that's something that's very unique to real estate, or not unique, I would say, but very like heavy in the real estate field. You're able to do that. So that's kind of the first benefit here is the ability to generate tax-free cash flow. So as you build your rental portfolio, whether it's directly or whether it's through syndicates and funds, you're able to shelter this income from tax, right? And what that does is that over time is it reduces your effective tax rate. So your effective tax rate is the amount of income that you're generating, or the amount of tax that you're paying rather, divided by the amount of income that you're generating. And as your income that you're generating increases and it's tax-free thanks to depreciation, your tax will remain relatively the same. So say, for example, you were paying $100,000 in taxes on your earned income. And your earned income was, I'm just keeping numbers simple here, was 500,000, just to keep things simple. Now, let's say that your effective tax rate in this case would be 20%. Now, it'd probably be much higher than this in reality, but it's 20%. Now, let's just say that you're able to generate $50,000 in tax-free cash flow, but your earned income stayed the same. So you're still paying the same 100,000, but now you have $550,000 of income. Okay, so now we're going to take that and we're going to do the effective tax rate calculation, and now your effective tax rate is 18.18%. So now it's decreasing. So that's the first benefit. In addition to that, you can also shelter the capital gains and depreciation recapture from the sale of properties, whether it be direct properties you own or syndicates and funds, using passive losses, which further aids in that concept. So that's the first benefit that anybody investing in rental real estate can capture, is the ability to generate tax-free cash flow and reduce your effective tax rate. In addition to that, something else I'd want to point out from an investment perspective, if you were to invest in a taxable brokerage account and you were to invest in stocks, right? This is considered portfolio income and it's considered non-passive under the tax code, despite that it might actually be passive to you. This type of income is also very hard to shelter. So you're going to be paying anywhere between 15 to 23.8% if you consider the net investment income tax on this type of income. So whereas with real estate, again, you're sheltering that. So that's the first benefit I want to point out, is just tax-free cash flow. And anybody.
Yeah, that's amazing. And I feel like, you and I, we want to keep deep diving into everything else because there's so many other things you can talk about that, are in ways in which real estate is tax efficient, even when you're a passive investor, right? But
Right.
what you pointed out is super powerful. And I often have, people in the community come and say, but Param, I can't tap into reps or the short-term rental strategy. So it's really not going to help me save
Right.
my income from taxes. And you effectively pointed out how the benefits of real estate extend to all real estate investors, even when you're passive. And you, Tom, you invest passively in syndications, you're benefiting from this, right? And so that's super powerful. And, can we pivot a little bit? And I know you probably want to talk about step-up and basis and, cash out refinance being tax-free, and we can, but can we pivot a little bit and talk about what happened in 2017, right? When President Trump came into power with the Tax Cut and Jobs Act, and how it really helped supercharge things for certain subsets of investors.
Yeah, absolutely. So the number one thing for real estate investors has been by far bonus depreciation. And from 2017 to 2022, bonus depreciation was 100%, which means you're able to completely deduct the cost of qualifying property, which is 5, 7, and 15-year property, which can range anywhere between 20 to 30% of an asset's value. So if you had a property that was 500,000, you're going to be deducting, let's call it, if $500,000 times 25%, if we split it down the middle, that would be $125,000 you're getting in a deduction thanks to 100% bonus depreciation. However, what has happened over the last few years since 2023, it's began to phase down 80% 2023, 60% 2024. And in the current year, it is currently 40%. So it's getting less and less powerful. However, The good news is that, let me back this up. So what you were able to do with this bonus depreciation before I get to what's coming back is if you're able to qualify as a real estate professional, or you're able to use a short-term rental strategy or the loophole, whatever people want to call it these days, you're able to take these losses and use it to offset your W-2 or your active business income, which led to substantial tax savings. But as bonus depreciation began to phase out, this is becoming less and less impactful. Now, bonus depreciation for passive investors, where that's most powerful, is again sheltering your rental income from tax and also helping you shelter gains from tax. But
Yeah.
where we are today with this is that the Trump administration, the second time around, they're really pushing to bring back 100% bonus depreciation. And Trump has indicated in one of his talks that he wants to bring it back retroactively to 2025. So meaning assets that you have placed in service this year would be eligible for 100% bonus depreciation. Now, will that actually happen? Nothing is set in stone, but it looks favorable. To kind of give you the latest update on where we are, the Senate this past weekend passed the first step of the budget resolution, which opens the gateway for what's known as the budget reconciliation. And all that means is that they're going to be able to pass a bill without having to have a supermajority in the Senate. They could have a simple 51 vote. And with that, it's largely expected that there will be a bill passed or at least on the floor around Memorial Day, and that will include 100% bonus depreciation. Now, the reason why 100% bonus depreciation is likely to come back is because it's one of the least expensive measures in that bill to extend. So it's largely expected that they will bring it back, and hopefully we'll have some news around Memorial Day, but we'll just have to wait and see at this point. I personally expect it to come back. It's just a matter of when.
Yeah, and those are such important points because when we didn't have that and that the ability to supercharge depreciation, you were still able to use depreciation against all of your passive income, right? Income from
Right.
rentals. But just having this strategy and then tapping into reps and the STR strategy, we're going to talk about that in a little bit, allowed you to now suddenly shelter large amounts of your active income, which could be 1099 or W-2 income from taxes. So I think, and you pointed out something that was also very important, they hope to bring it back retroactively. So anything, I'm assuming anything acquired, if it passes, anything acquired this calendar year you'll go back to having 100% bonus depreciation if placed in service and if you meet criteria. Yeah,
Yeah.
awesome. So trying to see which direction we want to go. Let's pivot a little bit and we'll come back to any other 2025 changes, Tom. But I think for people listening, I guess the question is like, how impactful can this be? And so let's talk about the limits in terms of how much active income you could potentially shelter and what criteria you need to meet for both reps and the STR strategy to be able to qualify and take all these losses on the real estate side and use it against other income producing activities.
Yeah, absolutely. So if you're, start off with the amount that you can do. If you're a business owner, there is no limit in terms of what you're able to shelter. However, if you have a W-2 job or you have other non-business income, then you're limited to 313,000 if you're single, and that's going to be doubled, so $626,000 if you're married filing jointly. And that's called the excess business loss limitation. So that just places a limit on the amount of losses you can take against non-business income. But for the real estate professional status, in order to qualify, the real estate professional status largely allows you to take losses from your long-term, in many cases, midterm rentals also fall into that long-term category, and allow you to take those losses and use it to offset your W-2 or business and other non-passive income. To qualify, you spend more than 750 hours and more than half your total working time in a real property trade or business. Now, this can be challenging for if you're, say, if you have a W-2 job, it's very challenging to qualify because spending more than half your total working time in real estate on top of a W-2 job that's full time is been proven very, very, very hard to do. And in fact, only one person's really been able to do in tax court, but you can have a spouse qualify. So that's the good news with the real estate professional status is if a spouse qualifies and you file a joint return, you both benefit. So that's kind of the real estate professional status. Again, midterm and long-term rentals largely fall into that bucket. Now, the good news is there's an exception to the definition of rental activity, which applies to short-term rental, which allows you to bypass the real estate professional status. And that you can qualify for. There's kind of two parts to it. The first part is going to be you have your property has an average period of customer use of 7 days or less, or 30 days or less, and you provide substantial services, which are hotel-like services like daily cleaning, meals, concierge, things like that you'd find in a hotel. If you meet one of those criteria, you're moving your rental into the business bucket. And with businesses, in order to take losses from business activities against your non-passive income, you only have to materially participate. You don't have to qualify as a real estate professional. To materially participate, there's 7 tests, but there's 3 that really matter for the majority of investors. And that's going to be you spend more than 500 hours on the short-term rental in this case, which challenging to do, to be honest. Or you could do substantially everything yourself. So you're a one-person band, very little to no outside help. Or you spend more than 100 hours and no one else spends more time than you, which is by far the more popular test. One last thing that I have to say on that is that for the real estate professional status, that's 750 and more than half your total working time. That needs to be met independently by one spouse. That's one person is meeting those tests. The other, with the material participation for the short-term rentals, that is combined with your spouse. So if you're married, you and your spouse are considered one person.
Yeah, absolutely. That's such a valid distinction to make. And this is how you hear about physicians. And there are a lot of physicians within our coaching program who acquire 2 short-term rentals and they bonus depreciated. And in just 1 year, they're able to get 800,000 of losses that they can use to shelter their active income from taxes. And correct me if I'm wrong, Tom, if they have their own practices, are they considered to be running a business? And so the loss isn't capped?
If you're interested in learning how to invest in long-term and short-term rentals the right way, so you can accelerate to financial independence with the support of mentorship, community, and vetted investor agents in strong markets across the country, then get on the waitlist for the next cohort of Creating Generational Freedom at www.generationalwealthmd.com. You don't have to learn from decades of costly mistakes by yourself. The program is only open for enrollment in the spring and fall each year. In the last 6 months alone, our members have acquired over $60 million of real estate, and more importantly, they're living life and practicing medicine on their terms. You don't have to do it alone.
Yeah, if you have a 1099 or you're otherwise running your own business, then you're a business owner and you don't have exposure to the excess business loss limitations. And technically, you could write off as much as income, as much losses as you have income. Beyond that, you'd have a net operating loss, which you just carry forward to the next year.
Yeah, and we've had 2 students do that last year where they had over 800K in losses and they were able to use it because they ran their own practices, right? And so as all of you can see, if 100% bonus depreciation does come back, then that really supercharges this because as opposed to we currently have 40% bonus depreciation, you're able to get significantly larger losses. And so that will be very powerful. Tom, before we move on, what else can we expect in terms of potential tax code changes in 2025?
Yeah, absolutely. So, with the biggest things I think would be relevant for physicians and doctors tuning in is going to be one of them is going to be the QBI deduction, the qualified business income deduction, which allows you to deduct 20% of your qualified business income. That's actually going to be phasing out, and if they want to extend and make that permanent. So I think that's a big one. It doesn't really help if you're on a W-2, but it does help if you're a business owner. So that's one of the big ones there. Another one would be, believe it or not, the tax rates are actually going to phase out too. So right now, 37% is the top tax rate. It would revert back to 39.6%. I believe it's after 2027, but they're looking to extend that as well. Another thing that they're looking into is that 10K cap on state income and property taxes. So right now, that's rough for people who live in high income states like in the Northeast, like New York or in California. But they do want to either eliminate the cap or perhaps raise it to $20,000. We'll have to ultimately see what makes it into the bill. But they do want to bring that back. And I think those are like the primary provisions that are going to really make sense for a lot of people. They want to extend R&D tax credits, but I don't know how relevant that would be for a lot of people here. It's often useful in the tech space though. So I think those are the major bullets. I'm going to take a quick look to make sure I'm not missing anything key, but those are going to be the major bullets for most of the people probably tuning in today.
Makes sense. And then business vehicle deductions. When we had 100% bonus depreciation, you could acquire certain vehicles over 6,000 pounds. And if they will use them primarily for business activities, which in this case would be for your real estate investment, then you could potentially get 100% bonus depreciation in year 1 in the year of acquisition. Now, I guess that also ties into the 100% bonus depreciation coming back. But anything else we need to know in terms of business vehicle deductions?
Yeah, that doesn't seem to be changing much. I think like you mentioned, 100% bonus depreciation is going to have the biggest impact on how powerful that continues to be. But beyond that, to my knowledge, there's nothing expected to change there.
Yeah, awesome. I wanted to touch upon medical office buildings, Tom, because a lot of physicians have their own practice and they own medical office buildings. And if you group your building to your actual practice in the first year, you may be able to take bonus depreciation from the real estate and use it to shelter your clinical income from taxes. And it has to be done right. So can we talk a little bit about that? We've had physicians who've done this and sheltered over $500,000 of, their practice income from taxes. But there
Yeah,
is a way to do it, and I just wanted maybe we can touch upon it for those who run their own businesses.
yeah, absolutely. So again, so rental, going back to the beginning, rental real estate's usually passive, right? Unless you qualify for reps or use short-term rentals. But there's another way, and that is you can group a business in with the building that's associated with that business. And the way that works is it has to be done like Param mentioned, in the first year that you kind of acquire so say you had your medical practice and you acquire the building, has to be done that year. You also have the ownership structures also have to be the same. So whoever, if the practice is owned 100% by you, you also have to own 100% of the building. If it's 50-50 with somebody, it has to be owned 50-50, so on and so forth. So those are like the two main requirements for it to happen. And then basically what happens is when you make that grouping election, because you're materially participating in the business that's associated with it, it's now non-passive, and that's like an exclusive carve out for people who have businesses where they can group the building. Works very well for medical practices, also works for other businesses too, but it could be quite powerful.
So one of my one-on-one students, they did that for the first building, and then now she's acquiring another practice and she's building, and all of that really, she's really supercharging her strategies using all of that tax sheltering. So that can be super helpful. Yeah, I feel like you touched upon material participation, right? What qualifies? We're already good as far as that is concerned. I did want to talk about investing because we have a lot of physicians who invest passively in syndication. Some of them, direct ownership also through retirement accounts. So can we touch upon the tax implications of using retirement accounts? That could be IRAs and 401ks because there are different tax considerations there. What should people keep in mind? Because I think the problem for a lot of investors, not just physicians, is that a lot of their equity capital is trapped in retirement accounts. And so
Right.
how do you open that up to investing in real estate or alternative assets? And what are the tax implications? Because there can be, really important tax consequences.
Yeah. So let me start with this. So whether it's a solo 401k or solo a 401k in general, usually a solo 401k is what will allow you to self-direct it or self-directed IRA. What you're doing when you're investing in an alternative asset like or real estate within that account, you're not able to really use you're not going to be able to use the losses to offset other passive income that you have outside of that or offset your W-2, even if you qualify for reps or the short-term rental
Yes.
loophole. It's kind of trapped in these accounts.
Yeah.
So that's kind of just the first thing to note.
And those are tax efficient per se. They're tax deferred vehicles already. So you're really not tapping into the
Yeah.
tax efficiencies of real estate.
Yeah. What I prefer to see, and I'll get into the tax implications of those for sure, but like just from like the tax side, I prefer to see people putting stocks, bonds, and securities in IRAs and 401ks because they're tax sheltered in those accounts. And it
Yeah.
is difficult to shelter them outside of those accounts, whereas real estate is already tax sheltered when you own it in your personal name or in like a
Yeah.
partnership or something like that, right? So that's typically my view of it. But so not only are you not really going to really benefit from those losses direct, outside of those, there's something called UBIT, unrelated business income tax. That's what it's called, and it's generated by UBTI, which is unrelated business income, and a subset of that is this is all just a mouthful, so I apologize, but it's UDFI, unrelated debt financed income. And basically, what happens is if you buy rental property through a self-directed IRA and it's financed with debt, then you're going to have a source of this income that's going to be subject to tax at the trust tax rates, which go from 0 to 37% relatively quickly. I think it's like basically almost a standard deduction, so it's like $13,000 or $14,000 at this point. So that can be problematic. However, what I would say is that it's not as bad as people think because you're able to use these losses to offset the income. So you often don't have income that's really going to be subject to this tax until really the end of the deal when you're selling. And at that point, you could have a substantial gain, and that could be subject to this tax. In my experience, it's a few percentage points off the return. It's not usually substantial. So it could be worth it if you want to diversify your assets outside of stocks. You just have to know that you might take a little bit of a hit. Now, with solo 401ks, it's a little bit different, or 401ks in general, if you're able to self-direct your 401k. That's not subject to it's not subject to UDFI, excuse me, on real estate. It's not the case for businesses that you might invest in, like say you invested in your friend's pizzeria, for example, but the real estate aspect of it is not subject to that DFI that I mentioned. So that could be the more advantaged vehicle to use when you are investing through a self-directed retirement accounts.
Yeah, I think that's such a valid consideration. People need to have these conversations with their CPAs ahead of time while they're deciding how to, invest capital within their retirement accounts in alternative investments. So that was amazing, Tom. Is there anything else we haven't touched upon in terms of potential changes for, changes to expect in 2025? Anything else you want to leave the audience with at this time?
So one thing that I would say is that real estate's not all about the tax benefits, of course.
Yeah.
It is about the investment merits of it as well, and being able to use it to build wealth over time. It just happens to be tax advantage. Also, like kind of Param mentioned before, it's not all about reps, not all about the short-term rental loophole. Those are powerful strategies, and if you can use them, by all means, go for it. But simply by investing in rental real estate, you're putting yourself in a tax advantage position because, again, you're able to shelter that rental income and often the gains from tax, which reduces your effective tax rate and really does help you reduce taxes. Because if you made that same money through your earned income sources, you're going to pay a substantial amount of taxes on it. So that's kind of something just to keep in mind. And whether or not it makes sense to buy real estate still today, spoke to a lot of different investors over the last few months. And basically it does, as long as you can find deals that pencil out. It's a little bit harder maybe, but it's people are still acquiring deals. So it's just a matter of finding the right deal. So that's all I have to say there.
Yeah, and spot on, Tom. I think, you're right. Don't let the tax tail wag the dog, but tax efficiency is a big part of real estate investing. And I remember I was completely oblivious to all the strategies that I could have tapped into before I took the tax strategy foundation course. And then I realized all the errors that have been made. I've been able to rectify some of them. Some of them I just had to make my peace with. And so it's always, for those of you listening, there's a huge difference in having a CPA who is real estate savvy, and that works if you're tapping into some of those advanced tax strategies we talked about, where you're able to shelter your clinical income from taxes. But it really is also super helpful for those of you who are passive real estate investors, and you could be losing money and leaving a lot of money on the table either way. And so highly recommend having a CPA who is real estate savvy. Tom and his team with Hall CPA, they do a special discount for our members. I think we have $500 off if you go through us.
Yep.
And so if anyone is looking, and I think a big part of tax planning is also like planning ahead of time. And there's the tax prep that happens, next year, but a lot of tax planning happens this year. And so if you're looking for tax planning or tax prep services, fill out the form at generationalwealthmd.com/CPA in lowercase, and we'll connect you to Thomas and his team. And like I said, especially if you're thinking about short-term rental strategy, or you're thinking about, qualifying for reps, you want to make a lot of changes ahead of time and plan strategically. And so this would be the time to reach out to them. Thank you so much for this, Tom. I feel like we could go on and on and on about tax strategies, and there are probably 10 things that we would have loved to touch upon, but this was super helpful.
No, thank you. Thank you for having me. It's always fun to do. So
thank you guys for staying on. I will let everyone get on with their evening, and I will see everyone next week.
thanks again for having me today.
All right, take care, Tom. I appreciate it.
All right, bye now.